welcome back to another week of Equity Mates. Very excited to be here as always. My name is Bryce and I am joined by my equity buddy Alec, or Ren, otherwise known as in the Equity Mates community. How are you going?
I'm good, Bryce. Back for another week. Our backdrop has slightly changed, so we must be
doing right things. Yes.
And what a week it was last week.
Yeah.
And I think we want to take a breath because we've certainly heard it from the Equity Mates community. What happened last week? Tech sold off a little bit, not as much as it has, but there was a lot of panic. I guess if people have only just started investing, maybe they think stocks only go up.
Well, I mean, you'd be right to think so, but there are a lot of members in our community last week who were a bit worried and a bit confused as to why, parts of their portfolio, particularly given those high growth stocks or tech stocks, were falling. It was also reporting season in the States and coming off the back of some pretty good results from these tech companies. And so the question was, what's happening? What is going on? So in this episode today, we are going to go back to basics a little bit and really just step through what is going on with inflation, with bonds, with their sell-off in the markets as well.
Stock market economics is a complicated, interrelated system.
Yes.
And in this episode, we'll break down how all of it sort of fits together.
Yeah. Hopefully we do a good job, but on Thursday we've got our in-house economist coming in.
He can tell us how wrong we were.
Thomas the economist, to break it down even further. So please do join us on Thursday for that. But Ren, let's start at the top and have a look at some of the stocks that were sold off, because a lot of them do certainly sit in our portfolios for our community.
Yeah. So let's just go down the list. It was a lot of technology stocks, a lot of growth stocks. The NASDAQ 100 as an index was down 4% last week. Apple was down 5%. Alphabet down 2%. Amazon down 4%. Spotify down 15%.
I was watching that closely.
Shopify down 8%. Tesla down 11%. Salesforce down 11%. I mean, the list goes on, but that just gives you an idea. Some of those numbers are big. Spotify down 15%. That's meaningful.
Yeah.
Alphabet down 2%.
Come on.
Yeah, but I think peak to trough in February, the NASDAQ 100 was down 7%. So it's meaningful, and a lot of the questions we got from the Equity Mates community were, what's happening here? Why is that the case?
Yeah.
And so let's try and answer that question.
Well, everyone's been talking about inflation. The fear of inflation, the big bad green monster inflation. And so shall we start there?
Sure.
Because there's been a lot of chat about it, and it can be pretty confusing if you've just started your investing journey.
I'm just still laughing at the big bad green monster.
I
don't think that's going to catch on.
Look, green, money printing. Anyway, so look, inflation. Firstly, very briefly, inflation just refers to the price increase in a basket of goods. It's not uncommon year after year for the price of this, basket of goods to go up. Reserve Bank or central banks try and keep that in a relatively stable position. But it's not good news if it starts to get out of hand.
Yeah. And for the last few years, we haven't really seen a lot of inflation in the economy, despite central banks pumping or printing huge amounts of money and putting it into the bond market and asset markets. So February, there was a bit of talk about inflation coming back into the economy, and that's on the back of more central bank stimulus. Just today we saw the Reserve Bank buy $4 billion worth of bonds.
Yeah.
Then the increasing government stimulus. In the US, they're talking about a $1.9 trillion COVID rescue package that will put a lot of money into the economy. And then there's also things, like the US is talking about almost doubling the federal minimum wage and stuff like that. So there's a lot of things in the economy that could lead to inflation.
Yeah, and there's also a lot of talk of heading into a period of pretty significant economic activity, which also is going to really, have put inflationary pressures on prices at the moment.
Yeah. So then what happened next? The bond market got a little bit worried. The bond market, the yields are at all-time lows. They're, historically, they're very low. They're 10-year US Treasuries about 1.5%
Yeah.
at the moment. Hypothetically, if inflation is at 2% this year, that means the bonds, the yield on the bond isn't keeping up with inflation.
Yeah.
And so the bond market sold off on the back of these inflation fears, yields rose, and then the market got a bit jittery.
Wobbly, yeah. Let's just take a step back though, for those of you who are probably feeling a bit confused as to what we've just spoken about. How about we address firstly what a bond is and what bond yields are, so that you can, I guess, understand more broadly why this is probably impacting your portfolio. So, bond yields.
So, well, bonds,
Bonds.
first of all. Bonds are just debt. Companies, governments want to raise money, and so they raise it in the bond market. They sell bonds to investors. Investors give them money, and then over time, the company or the government pay that money back with interest. And that interest is called yield.
Yeah, it's a big IOU from the government.
Yeah.
We're going to lend a bunch of money and then pay you back over a period of time with some interest.
Yeah.
Sounds pretty good. However, the thing that is happening at the moment is that bond yields are rising and starting to scare off the stock market. So what is the issue there?
Yeah, so, I mean, there's a couple of things, probably two key things. First of all, investing is a relative game.
Yep.
The economics textbooks would say that investors are judging the risk-adjusted return of every asset class and deciding where to put their money. And if bond yields are rising, so the amount of interest you can get paid on a bond is going up, that changes the equation for investors, and bonds start to look more attractive as they can get more money from buying them. On the other hand, as inflation comes into the system, the central banks need to control that inflation, and they may do that by raising interest rates.
Yeah.
Now, traditional valuation of stocks is that the stock price is the present value of all future cash flows, and basically you discount the future cash or the future profit that the company will make back to the present day, and that's the value of the stock price. If interest rates go up, the discount rate in theory goes up, and the present value of a company's future cash is lower.
Is less.
If you didn't understand that, that is completely okay. But basically, higher interest rates are not good for stock valuations, is the Cliff Notes version of that.
Yeah. So I guess, what does it all mean from here? So to put it in a bit of a nutshell, what is happening is there's a risk that we're going to see inflation. The economy might be heating up, and heating up faster than central banks would like. As a result of that, they are going to start potentially implementing some monetary policy, which is through interest rates.
Yeah, they may raise interest rates.
Yeah.
They may stop buying bonds.
Yeah.
They'll tighten monetary policy.
And as a result of a rise in interest rates, that impacts the valuation of shares today.
Yes.
And that is what is potentially scaring a lot of the investors in the market.
Yeah. And scary might be the wrong word.
Sorry.
But it's impacting the valuations that some of these high growth companies are getting.
And we know over the last sort of 10 years or so, particularly the last 5, these companies have been, teetering around what a lot of people would say is pretty phenomenal valuations. Some just say they're hard to justify. And it's at moments like this where interest rates do rise that those valuations start to come under scrutiny a little bit more.
Yeah.
And that's where I guess a sell-off might occur.
Yeah, if people want to a recent historical analogy for the impact that interest rates can have on share prices, December 2018, the central banks increased interest rates and stocks sold off as a result.
Yeah.
And that was pretty quickly corrected, and they increased interest rates pretty quickly. But yeah, like it happens. It's how all the economy is interrelated. The stock market is related to the bond market, is related to the real economy and inflation in the real economy. And this is a classic example of, nothing changed for Tesla or Shopify or Salesforce in the past week. but it's just how investors are allocating capital.
Yeah.
And as things are changing, their valuations are changing as a result.
Yeah. It's also worth pointing out, Ren, that the market is, I believe, still incredibly divided on whether or not we are going to see inflation or not. So let's just point out here that we're just explaining what we have seen happen, and it's not necessarily an indicator that we are definitely going to see the interest rate rises, which probably leads to the next question of, you know, as a beginner investor or someone who has seen their portfolio drop, what does this all mean for me as an investor? How should I be playing this, knowing that there is potential for rates to rise?
Honestly, people could have just skipped the last 10 minutes of this show and just come here. No, but I think, you know, again, to reference all the people that reached out about, you know, their spaceship portfolios or their NDQ NASDAQ 100 ETF and were asking what's going on. This is really the crux of it, because even if you got lost in that last 10 minutes of explanation, that's okay. And this is really the point of it all.
Yeah.
My first thing would be do nothing.
Yeah, well, I mean, that's our thesis, isn't it? Do nothing.
I think you enter, if you bought a specific company or you bought an ETF, you had a thesis when you bought it.
Yeah.
And I would hazard a guess that from almost everyone, the thesis wasn't, well, the NASDAQ index looks really good on a risk-adjusted basis because interest rate, or the 10-year Treasury bond yield in December 2020 was less than 1%.
No, you're right. Yeah. So just like in any situation like this, if your thesis hasn't changed, you bought the stock for a particular reason, and that hasn't moved, continue holding and just see what happens. I mean, there's no reason for you to sell off just because, as Ren said, the risk-adjusted return is somewhat different.
Yeah. So like the fortunes of these companies haven't changed. I mean, look, if they are raising a lot of debt and they need to issue more bonds to fund their operations, then their cost of finance or their cost of capital may go up a little bit.
Yeah.
But on the whole, these companies, Alphabet, Amazon, Shopify, are going to keep doing what they're doing, regardless of how investors are buying and selling bonds.
Yeah.
I mean, a classic example of that, we interviewed Hamish Douglas from Magellan last week on the podcast. He pitched Netflix, and Netflix, is about a $200 billion company, and his thesis is it's going to be worth more than $1 trillion in the next 5 or 10 years.
Yeah.
It doesn't matter if the bonds are yielding 1%, 3%, 10%. Like that thesis of his thesis around Netflix doesn't change. And so, for me, the first thing is if your thesis still holds, you shouldn't panic that the markets are moving. We all know that markets move every day for a number of different reasons, and this is just one of many reasons.
Having said that, though, I would be prepared for some shorter-term volatility, though, and what might be a little bit painful in the short term. With that long-term view, though, have a look at markets over a long-term view, but that short-term period might be a little bit painful, particularly if you'd been in the market in the last few years and really used to your portfolio just going up and up. Just be prepared that you might be facing a little bit of headwinds.
Investors are selling high growth stocks. They're moving to the recovery stocks, as they're called, or cyclicals. They'll be moving some money into bonds if yields keep getting better. And so this crazy period since March 2020 where tech stocks and growth stocks have just dominated. It was never going to continue forever, and this is that story sort of softening a little bit. Get ready for, I guess, a bit of short-term pain, a bit of volatility.
And you go.
You go. I was going to say the other thing that we might see is investors that are investing for income, have been buying a lot of dividend stocks because bonds have been yielding 1%, less than 1%, now a little bit more than 1%. Well, at least, US government bonds. If bond yields keep rising, potentially some of those income investors might move from dividend stocks to bonds again. So we might see that, but bond yields probably have to rise a little bit more before that starts.
Get a decent income, Well, you stole the words right out of my mouth, Ren, and that brings us to the end of another episode for this week. It's great to be back on a Monday. A lot going on in markets. As we said, on Thursday we will be having our in-house economist Thomas come in to help us unpack all of that in a little bit more detail, and he will of course bring in all of his amazing charts to help us get a better view of what's going on. So yeah, if you would like more information on Equity Mates, you can head to equitymates.com. Alternatively, you can send us an email at contact@equitymates.com. But Ren, another week.
Yeah, tune in tomorrow. We're going to be breaking down the world of ETFs. And then we've got Watchlist Wednesday coming up.
Yep.
And then, as you said, Thursday, we've got Thomas, the economist, coming in. So big week covering everything from ETFs to macroeconomics to individual stocks. So can't wait for you to join us again, same time, same place tomorrow.